How do you trade when it keeps going down and down and down for small pullbacks like yesterday's ES on the 5-minute? When do you know it's a strong downtrend? So there are a few clues that happen when a downtrend is going to take place. One of the first obvious ones, which I don't think I even need to explain, but lower lows, lower highs, right? Whoa, what a shock. So it's as long as you're utilizing 5 minutes, that's the type of situation that you need to see, is those lower lows, lower highs. Well, when we started the day off yesterday, we had a really strong bull bar after a little gap to the downside. They're probably going to try to fill the gap. And a lot of buyers are going to buy with that assumption, myself included. I was even buying on the dips, but it didn't go up. It never filled the gap. It didn't complete anything. So when it failed that completion of the gap and it starts putting in a bear bar, okay, not a big deal. Buyers are still going to buy because it's one bear bar that barely took anything back, right? If you look at it in context and get rid of everything else, that's all you see. That still looks fine to me, right? There's nothing that is really a warning sign there. And then you get that bear bar, and now you're thinking, okay, well, it's another follow through bear bar. That's not great. It's a strong bear bar. We've pulled back about halfway on the first 5-minute. Not a huge deal, but it's not really what you want to see. And you can see on that big wick to the upside, a lot of traders who were maybe a little bit nervous likely took that as an exit sign. They didn't get the follow through that they wanted, and they jumped ship. Those are the scalpers, real fast movers. If we continue going forward, though, that weak bear bar, it's the third bear bar in the sequence. It's not very strong, but it is still the third bear bar in a sequence. That is not what you want to see as a long. You should still have bull bars going in your direction if you're in the right side. So a lot of traders will exit after the first candle. Some might wait for a stronger bar as confirmation. You have an inside bear bar. Well, I don't know about you, but if I were nervous, like let's say I bought above that first candle of the day. I didn't, but let's just play pretend for a second. And we dip down and we see bear bar, bear bar, bear bar that may have taken traders out at break even. Okay, what's it want to do? Now I've got an inside bear bar. We've got weakness, maybe. But do I really want to hang on if it starts breaking underneath that? We've got volume underneath. So some buyers will say yes, and they'll keep accumulating underneath the low. So some buyers will be buying the dip. A lot of the scalpers, though, they already saw their reason to exit. They're not going to hang on underneath this bottom. So there are going to be exits underneath that as well. Now, obviously, that was a little bit of a cascade effect, but they broke out aggressively. And if you want to know why it came back to that point, well, that's where they weren't sure. Like, well, I don't know. Maybe I should, maybe I shouldn't. It dips underneath the low. I'll buy a little more. Dips underneath the lows again, maybe they buy a little more on the DP, or they buy below the next low. Remember, there's a lot of different ways to manage this. For me personally, if we were looking at the move to the downside, there was that initial breakdown underneath the lows. Typically, when you break down that aggressively, you see a one-to-one move. That's fairly common. So the initial move would be off the top to the bottom, and then take that. Oh, logarithmic chart. That's not going to work, right? Let me use the fib tool. There we go. So the one-to-one move be right there. So a lot of traders will be looking to buy at that point as well. So they'll have entries here, they'll have entries here, they'll have entries here, and all of them, not a single one of them gave them a chance to get out of break even, right? This was too short. Unless they went like 3-1 or something like that, then sure. But realistically, a lot of buyers, myself included, for quite a bit of the day yesterday, will have been stuck long and just waiting and buying lower and buying lower. And this is why you space things out. I wait for what I call the knife in the board before I buy below the swing. I need to see it actually, boom, right, hit the floor. So this, on this initial move down at the time, would have been good enough. This is obviously good enough. These little bitty swings, though, those aren't good enough anymore. Same with this. It's not good enough. You're not buying under those. You're buying under these where it's really obvious. There are still longs who are stuck from yesterday, not myself included on that one. I exited at a break even on this pop here. But when you've got this rotation like this, there's still looking to get out. A lot of traders probably got out on that, to be fair. And if we measure the volume, actually, this will be a really good clue to see if it was accumulation on the way down. Check the volume. got a big break, and then volume decreasing. So this tells you right here, this move down was not accumulated. Not a single bit of it. This is profit taking. Volume is lessening while the market is going down. That is exact profit taking. Sellers who sold up here, back here, whatever, they take profit, it goes further. They take profit on what's left, goes further, take a little bit more, goes further, take what's left, right? They don't have as much as it's falling further. So no accumulation has taken place down on that move. I was accumulating it, but I guess nobody else was. But as we continue a little bit further forward, this is where we want to see what happens to the volume. Now the POC shifted. We've got a downweighted POC. There's a lot of volume that built in. And if we put in a new low, let's see what happened now. Ooh, there's your answer. Now you have accumulation. See the difference? Now buyers are accumulating.